Absorption cost. For the determination of cost of a product or service under marginal costing, costs are classified into variable and fixed. All the variable costs are part of product and services, while fixed costs are charged against contribution margin. Product, inventoryable costs are the costs which are associated with the purchase and sale of goods, in the case of merchandise inventory. Contribution or contribution margin is the difference between sales revenue and total variable costs irrespective of manufacturing or non-manufacturing. Period cost are the costs, which are not assigned to the products but are charged as expenses against the revenue of the period in which they are incurred. Distinction between marginal and absorption costing. Under marginal costing, only variable costs are considered for product costing and inventory valuation. While under absorption costing, both fixed and variable costs are considered for product costing and inventory valuation. Under marginal costing, fixed costs are regarded as period costs. The profitability of different products is judged by their PV ratio. While under absorption costing, fixed costs are charged to the cost of production. Each product bears a reasonable share of fixed cost, and thus the profitability of a product is influenced by the apportionment of fixed costs. Under marginal costing, cost data presented highlight the total contribution of each product. While under absorption costing, cost data are presented in conventional pattern. Net profit of each product is determined after subtracting fixed cost along with their variable costs. Under marginal costing, the difference in the magnitude of opening stock and closing stock does not affect the unit cost of production. While under absorption costing, the difference in the magnitude of opening stock and closing stock affects the unit cost of production due to the impact of related fixed cost. In case of marginal costing, the cost per unit remains the same, irrespective of the production, as it is valued at variable cost. In case of absorption costing, the cost per unit reduces, as the production increases, as it is fixed cost which reduces, whereas the variable cost remains the same per unit. Difference in profit under marginal and absorption costing. No opening and closing stock. In this case, profit loss under absorption and marginal costing will be equal. When opening stock is equal to closing stock. In this case, profit loss under two approaches will be equal provided the fixed cost element in both the stocks is same amount. When closing stock is more than opening stock. In other words, when production during a period is more than sales, then profit as per absorption approach will be more than that by marginal approach. The reason behind this difference is that a part of fixed overhead included in closing stock value is carried forward to next accounting period. when opening stock is more than the closing stock. In other words, when production is less than the sales, profit shown by marginal costing will be more than that shown by absorption costing. This is because a part of fixed cost from the preceding period is added to the current year's cost of goods sold in the form of opening stock. Cost and profit statement under marginal costing. Product costs are the costs which are associated with the purchase and sale of goods, in the case of merchandise inventory. In the production scenario, such costs are associated with the acquisition and conversion of materials and all other manufacturing inputs into finished product for sale. Hence, under marginal costing, variable manufacturing costs constitute product costs. Finished goods are measured at product cost. Work in process, WIP, inventories are also measured at product cost on the basis of percentage of completion. Contribution or contribution margin is the difference between sales revenue and total variable costs irrespective of manufacturing or non-manufacturing. It is obtained by subtracting variable costs from sales revenue. It can also be defined as excess of sales revenue over the variable costs. The contribution concept is based on the theory that the profit and fixed expenses of a business is a joint cost, which cannot be equitably apportioned to different segments of the business. In view of this difficulty, the contribution serves as a measure of efficiency of operations of various segments of the business. Period cost are the costs which are not assigned to the products but are charged as expenses against the revenue of the period in which they are incurred. All fixed costs, either manufacturing or non-manufacturing, are recognized as period costs in marginal costing. If I have to put this in a formula, then contribution is equal to sales or revenue less total variable cost. Income statement under absorption and marginal costing. In absorption costing, the classification of expenses is based on functional basis, whereas in marginal costing it is based on the nature of expenses. In absorption costing, the fixed expenses are distributed over products on absorption costing basis, that is, based on a predetermined level of output. Since fixed expenses are constant, such a method of recovery will lead to over or under recovery of expenses depending on the actual output being greater or lesser than the estimate used for recovery. This difficulty will not arise in marginal costing because the contribution is used as a fund for meeting fixed expenses. The presentation of information to management under the two costing techniques which is shown here. It is evident from the above that under marginal costing technique the contributions of various products are pooled together and the fixed overheads are met out of such total contribution. The total contribution is also known as gross margin. The contribution minus fixed expenses yields net profit. In absorption costing technique, cost includes fixed overheads as well.